Most people think wealth comes from working harder, more hours, more promotions, higher salary. That path seems logical. But something strange happens when people analyze long-term wealth. Income alone rarely creates financial freedom, because income stops when work stops. Assets are different. Assets continue producing value even when nothing new is happening. And one of the most interesting assets ever designed is rental real estate. But not because houses are exciting, because of what they quietly do over time. A rental property slowly rewrites the balance sheet, and most people do not notice it while it happens. They see rent. They see tenants. They see maintenance. But they miss the deeper mechanism, because the real story is happening underneath the surface. Let us start with a simple observation. A house is one of the few assets people can control mostly with borrowed money. Banks are willing to finance real estate. That single fact changes the entire investing equation. Imagine an investor buys a property for $450,000. Instead of paying the full price, they put down $90,000. The bank finances the remaining $360,000. Immediately, something interesting occurs. The investor now controls a $450,000 asset. But only $90,000 came from personal savings. This is leverage. Leverage allows small capital to control larger assets. But the deeper story begins after the purchase. The property is rented. A tenant pays $2,100 every month. At first glance, that looks like income. But the rent is doing several jobs simultaneously. First, it covers operating costs, property taxes, insurance, maintenance. The rest goes toward the mortgage. Inside that mortgage payment, something important is happening. Principal reduction. Every month, a small piece of the loan disappears. Quietly. Slowly. But permanently. The debt balance begins shrinking. Now imagine 5 years passing. The mortgage balance might drop from $360,000 to around $330,000. $30,000 of debt vanished. But the investor did not pay it. The tenant did. Now here's where things become interesting. While the debt was shrinking, the asset itself may have been increasing in value. Housing markets rarely move perfectly, but long-term trends tend to follow economic growth. Population rises. Land remains limited. Construction costs increase. These forces slowly push property values upward. Assume a modest 3% annual appreciation. A $450,000 property becomes about $520,000 after 5 years. Now pause for a moment. The investor originally invested $90,000. But the property value increased by $70,000. At the same time, the mortgage balance fell by $30,000. Together, these forces changed the investor's position dramatically. Equity expanded from $90,000 to around $190,000. That is the quiet transformation many people miss. Because nothing dramatic happened. No viral investment. No huge market gamble. Just a system operating slowly. Now imagine another 5 years pass. 10 years total. Property value might reach about $600,000. Mortgage balance might fall to roughly $300,000. Now equity equals $300,000. The original $90,000 investment created $300,000 of ownership. And the investor may still be receiving rental income. Even a modest surplus matters. Suppose the property generates $300 per month after all expenses. That equals $3,600 per year. 10 years creates $36,000. Income produced by the asset itself. Now something subtle begins to happen inside the investor's thinking. They stop viewing houses as homes. They start viewing them as financial engines. Engines that convert time into ownership. Because every year two processes continue working. Debt becomes smaller. Asset value becomes larger. The gap between them keeps expanding. And that gap is wealth. Now imagine the investor decides to expand. They use accumulated equity as leverage. A bank allows refinancing based on the higher property value. Part of that equity becomes capital. That capital funds the next property. Now two properties are running. Two tenants. Two mortgages shrinking. Two assets growing. Each property runs the same system. Each one producing equity expansion over time. Now imagine 15 or 20 years passing. The earliest mortgages are almost gone. Some properties may even be fully paid off. At that moment, the structure changes dramatically. Rent that once paid mortgages now becomes income. The bank is no longer part of the equation. The property continues producing rent. but the loan no longer exists. This is when the system reveals its full power. Assets are producing income. Equity is large. Debt is minimal. Financial flexibility becomes enormous. And here is the fascinating part. From the outside, nothing looked extraordinary. Just a property, a tenant, a rent payment. Yet behind that simple picture, a powerful financial shift was occurring. Ownership was increasing. Debt was disappearing. Equity was growing. Year after year. This is why long-term investors often describe real estate as slow wealth. It does not look exciting in the beginning, but it is extremely persistent. And persistence is what compounds over decades. Eventually, the investor looks back at the original purchase, the one that felt risky, the one that required courage, and realizes something surprising. That single decision started a chain reaction powered by leverage, tenant payments, market growth, and time. If this perspective changed how you think about wealth building, you may want to stay connected to the channel. Because the most powerful financial ideas are often the ones hiding in plain sight.